Okay, I think we are live. Um, Excuse my little bit of clumsiness here right now because I am trying a new setup. So, um, welcome back everyone to Fat Free Economics. Today we're going to do an update on the inflation numbers, right? And we've talked previously about, there's no hyperinflation, but there is a real policy question about whether the recent increases in prices are permanent or temporary. And there's a debate going on between private economists and the Fed. And so we want to kind of dangle into that. But first, before we get into that, and I promise I'll be brief, I want to just a couple of quick notes. Number one is I realized that there were technical problems with the previous videos, especially with the audio being out of sync with the video, and also there were problems with the image quality because the bit resolution was so low. I'm trying a whole new streaming setup. That's why you saw me messing around a little bit at the beginning. But in any case, yeah, this is a whole new streaming setup, and hopefully this will fix the problem going forward. So, anyways, with that said, let's take a look at some of the more recent headlines because my channel is about decoding the real meaning behind the economic news that's reported in the mainstream media. So, let's take a quick look. Okay, so here you see that, okay, let me expand the size a little bit for you. Here you see that there's a recent headline in CNN Business News, and basically it says prices keep soaring, inflation rockets to a 13-year high. Now, I understand when you see a headline like this, it is a bit alarming, and I would admit, you can't ignore, uh, you know, um, something like this. This is uh, noteworthy news. However, we need to put this in the proper perspective. So let's move on to the actual data itself, right? And this is a chart of the inflation rate for this year, going back to July 2020. And these are numbers from the U.S. Bureau of Labor Statistics, right? And when you see this chart, you can get the sense that inflation is really out of control, right? Initially, it started with 1.3, 1.4, and the increases are ramping up very quickly, right? So, are the recent increases significant? Yes, they are. There's no denying that, right? So, yeah, the percentage increases are significant. The graph climbing upward is definitely significant. The question again comes back to, is it permanent or is it temporary? And for us to get a sense of that, we're going to take a look at a more historical chart, look at some more price data going back further. It's the kind of data that I showed you before in terms of trying to debunk this whole hyperinflation thing. But let's bring that chart on the screen and we'll talk about it. Okay. Now, this is a chart um, that plots the inflation jump relative to others going back to 1970. Okay. Now, this gives a more historical view, as I said. And the reason why I bring in this type of numbers is because when you look at how inflation has acted over the years, you realize, yes, in this area right here, in the current area, the jump in inflation is quite significant, right? But we have had past uh, uh, periods where an increase in inflation was even higher. And we're talking about 1980s, 1975, the 1990s. And what's noteworthy is that this gray area that you see in this chart are times of a U.S. recession where the economy was going down. So, for example, um, you know, um, 2010, we had, uh, somewhat of a severe recession. And you can see that prior to the recession, the prices were actually going up. And then once the recession uh, happened, right, um, the price started to plummet because no one's buying. No one's really earning income. There's a lot of anxiety uh, in the air. And so prices started to come down, and then as the economy recovered, it goes back up and down. Okay, so the past periods where you see prices going downward is primarily due to the fact that there was a recession going on. But we know in 2020, something other than that happened. And that's why this particular economic downturn and this particular resulting price bounce back is a little bit unique, right? It's not a recession in the traditional sense. It's a lockdown. We all know that. It was a pandemic. We were all locked in our houses thinking this might be the end of the world. Kind of joking, but you know what I mean. So initially we thought it might be 3 months and then it extended on down to 14 months. But the point is, this downturn in the economy is not the typical business cycle downturn that we saw in previous times, right? And I'm going to bring that chart back up again. And so the reason I point this out is that, this is a downturn. You see this gray shaded area here, but in fact, prices are starting to go back up, right? Not the typical price behavior that we would have expected, right? And so what's going on? Well, what's happening is that people were locked down. They weren't spending money. They accumulated quite a bit of savings, actually, right? And now that the economy is opening up, there is a surge in demand, right? And prices are starting to go up because um, there is a lot of dollars chasing um, a more limited supply of goods and services. Why is there a limited supply? Limited supply is because there were supply chain problems. And a lot of the factories and businesses were shut down. That makes sense, right? And we'll talk more about that as we move along in this analysis. But I think you get the point, right? Not only is it the fact, bringing the chart back up here, that this particular price increase is not the biggest in history. We have gone through much worse, right? The bounce back in terms of the pricing in other times have been because the recession brought things down and then we're recovering going back up. Here in this case, we are somewhat still in a down, what is officially a recession, right? That might surprise some people who are listening to the broadcast, but officially, the government body that declares the start and the end of a recession has not actually said that the recession is over. I think there may be a time in the near future where that happens. But as you see in this chart, we are still technically in a recession and yet prices are going back up again, right? Again, which demonstrates the fact that, uh, you know, this is a different nature of a price bounce back, right? And in the previous update on inflation, I made note of the fact that the public perception of inflation, inflation expectations is often wrong. I showed you some data about that. And I also pointed out that, the bond market itself, and of course, including the stock market, also has forward expectations about inflation. And what we've seen in the market, in the data lately has been that, you know, in the previous live stream I showed you, the bond market is actually discounting any kind of structural permanent increase in prices, right? And so we'll see that's actually still happening right now. So let's take a quick look, right? Um, this is a quote basically describing what's happening with the recent price increases. And I'll read quickly from the text. The uptick in inflation in recent months is thanks to a mismatch between a vast amount of pent up demand and limited supply of goods and services that COVID-19 made unavailable for almost all of 2020. Thousands of Americans hoping to finally travel in 2021 have helped drive up the price of oil and gasoline as well as airfare. Desire for travel and road trips has also fueled a historic appetite for used vehicles. Okay, so um, let's start with this headline right here, which is inflation just jumped the most in years, yet markets are largely ignoring it, and here's why, right? And the reason really has to do, this is the reason why I pull up these articles, not others, is because there's a lot of uh, economic news in the mainstream media that has the wrong interpretation, has the wrong slant. And what I do is I use my judgment to find articles and data that is actually a correct, a correct portrayal of what's happening in the economy, right? So let's talk about why this jump is being mostly ignored. Uh-huh. And basically, um, this is a quote from Jamie Foxx, managing partner at Harris Financial Group. And he's saying, quote, the headline CPI numbers have shock value for sure. However, once you realize that a third of the increase is used car prices, the transitory picture becomes more clear. Inflation is rising, but things are well behaved and have not changed materially. Now, you might actually, uh, sorry, I realized I didn't have the quote available for you, so I'm going to bring this up while I talk. You may kind of shake your head and saying, what do you mean things are well behaved and have not changed materially? Well, the fact of the matter is that he's referring to this situation um, where we were in a lockdown. Right, this situation right here. We were in a lockdown, and there was pent up demand and limited supply. And so, if you uh, keep that in mind, right? And here he's talking about inflation is rising, but things are well behaved and have not changed materially. If you keep in mind the fact that, you know, um, a lot of the things that are happening after the lockdowns were lifted were anticipated by economists. We knew that these kinds of fluctuations were going to happen. We certain, excuse me, uh, I have allergies, so sorry about that. But we knew that there would be a lot of fluctuations in the supply and demand. We knew there would be fluctuations in prices. We didn't know exactly how much they would fluctuate. We are not certain about exactly how long they would fluctuate, but it's kind of like dropping a stone into water. You expect these fluctuations to happen. So that's not a surprise. And that's really what he's talking about here, right? Um, when he said things are well behaved and have not changed materially, what he's really saying is the whole dynamic of the aggregate supply and aggregate demand situation is about what we expected, right? Um, when we came out of the pandemic. So that in itself is not really much of a surprise. Okay, so let's go on with the analysis. And so I already showed you this this quote or this observation, which is the uptick in inflation in recent months is again we knew fluctuations were going to happen. We knew that price increases were likely, but really you have to kind of think about why it's happening. So when you do an analysis, okay, let me talk for real quick about, like they say, real talk. You know, let me talk real quick about trying to do an analysis of inflation numbers. I see a lot of commentary on YouTube, which, quite frankly, is pretty bad. A lot of uh, lay people and amateurs. That's the way I put it, are simply making predictions about inflation by looking at the numbers like the chart and saying we're just going to extend the line upward, right? And that's not how economists analyze inflation numbers, right? In the first live stream that I did about inflation, I noted that inflation is not a thing. It is a measurement. It is a net measurement that happens when uh, supply and demand have equalized, right? Price signals regulate supply and demand, right? So when you want to analyze the future trend for inflation, what you really need to do is analyze the underlying causes of why prices are going up or falling, right? And this is exactly what we're doing right now in this stream, right? So instead of just, looking at numbers and drawing a straight line, we're taking a more thoughtful approach and looking at the underlying causes. And so if you look at that, you know, um, in the previous uh, quote, it notes that you know one third of the price increase is used car prices, right? And we are having a historic increase in demand for travel in terms of gasoline, airfare, and especially for used automobiles, right? Now, even as we make that observation, you have to ask yourself, how long is this going to continue? I mean, it can't continue indefinitely because, the deferred travel that people have wanted to do is starting to happen, right? And they're going to work their way through that, and things will eventually normalize, get back to normal, right? So the pent up demand means a surge, but we kind of anticipated that, right? So now that we've kind of worked through some of the issues, right? And I know you're going to continue hearing some scary headlines in the news about, 13-year increase, you know, um, in inflation and all these numbers and all this stuff. But I would ask you to keep in mind, right? Um, the chart that I showed you here, when you hear all these, kind of scary numbers and stuff, realize that our current increase, you know, based on a causal factor analysis, we're kind of sure that this is temporary. And even the current increase in inflation, right? It doesn't really compare to some of the past ones that we've had. So this kind of alarmist tone with regards to inflation, I think, is a little out of proportion. I'm not saying ignore it. I'm not saying that it's not hurting people, but when you place it in historical perspective, you realize it's not nearly as bad as people make it out to be, especially considering that this is a different beast altogether in terms of the price back. Now, as I said, I'm not saying ignore the dangers of inflation because I'm going to get to the point of the thumbnail. I promise you that wasn't clickbait, which is that um, does the current rise in inflation pose a threat to your wages, right? So let's get into that topic right here. So bringing up, um, sorry, let me just find that. Okay, here we go. Yes, there's one. So this is average hourly earnings going back to past 2017. And the thing to note here is right here in our current situation. You saw that, with unemployment and job losses that numbered into the tens of millions, right? Over 10 million. There was a real loss of what people were not working. They're, and there was some relief being made that was made possible through the unemployment benefits and so on. But the a drop in real wages is it's real, and this data is coming from the U.S. Bureau of Labor Statistics, and now is starting to climb back up again because of some of the other um, things that we've discussed in the streams that I've done about the labor market shortage, right? So workers now are having more leverage and are able to command higher salaries, higher wages because of the shortage. And in terms of the cause of that, we analyzed that in the previous stream. So if you're wondering about that, I do give what I believe to be some thoughtful commentary on the underlying causes to help you better understand what's happening. But the point here is this: the wages that are rising right now are beneficial to workers, but we do have to note, as we saw in the chart, right, that inflation is rising at least in the short term, right? So in the short term, inflation is rising, and is it possible that the gains that have been made um, in real wages will be in fact wiped out by inflation? And I have to tell you honestly that it is possible. Again, I do expect inflation to be a short term cyclical thing. And by short term, as economists, we're talking about less than a year. So some of the price increases may continue up to the end of this year. You know, especially anything that's related to the chip shortages. The car market and used car market is being affected by that issue. And what I would say about the semiconductors and computer chips is that that industry is extremely expensive in terms of ramping up production. So it's no surprise that they're having supply problems aggravated by COVID. So getting back to the topic now, how would this actually work, right? In terms of inflation eating away at the gains that you've had in your wages. So let's take a quick look at the chart. And so here we see that yes, reading from the text, workers already saw a bump in their paychecks for June. As of the latest tally, average hourly earnings rose 0.3% month over month and 3.6% year over year, according to the labor market. However, incremental wage increases are unlikely to keep pace as the cost of living rises, cautioned David Welliver, founder of Money Under 30. Okay, so um, first thing to note is that his prediction about incremental wages unable to keep pace is his opinion. Okay, that's not locked in stone. That is a possibility, right? But if that happens, well, what is the mechanism? How does that actually happen, right? Well, um, the reason why that happens is there's a lag between the increase in prices for gas and groceries and whatnot. But most people typically get an increase in their hourly rate or a salary, um, once a year or twice a year or something of that nature. Certainly not every day. You know, it's kind of a joke, but I'm sure you've noticed that gasoline prices go up really fast, but they are reluctant to come down. Once prices go up, they do come down, but it's at a much slower pace. And I think a lot of it is because businesses and corporations, it's not a conspiracy, but they're worried about potential other spikes or future spikes in the cost of materials and the cost of labor. So they're simply being very cautious to bring down the prices because they don't want to have this, yo-yo effect in prices and confuse consumers. But in any case, the net effect of that is that these price increases will happen in the short term, and because your real wages, right? By real wages, we're talking about the inflation adjusted uh, dollars that you get as payment for your labor. They don't adjust as fast as the prices do at the grocery store, right? So is that a real potential threat to workers? The answer is yes. Yes, it is, right? So in terms of key takeaways from the stream for today's stream, okay, there are 3 points that I would ask you to consider. One is that used car market prices is one third of the recent prices in the CPI, Consumer Price Index. And so, uh, as a matter of a causal analysis, we are still uh, feeling pretty sure that, as these supply chain issues are resolved, as aggregate demand for travel and those things start to diminish, these price increases will be temporary, right? And that's somewhat validated by the fact that the markets, like the bond market, are ignoring price increase. Now, the bond market is by no means infallible, of course, right? But they are typically run by or they're managed by professional money managers who are a little bit more aware of the total underlying economic data. And when people talk about you know inflation risk, right? It's certainly not hyperinflation, but is there a risk that there is a short-term pressure that would be applied to your wages because the shifts in price of consumer goods and commodities happen on an everyday basis, but your salary it's just adjusted maybe once a year? And the answer is yes. So hopefully the price increases will moderate very, very soon, right? And we can go back to a more stable situation with regards to our expectations about inflation. So, anyways, so that's it for today. I wanted to let you know I stream every Wednesday night and Sunday afternoon. Yesterday, I couldn't, this is Thursday. Yesterday, I couldn't stream because I'm still trying to fix all these audio issues and technical issues. So please bear with me. But anyways, that's it for tonight. I hope you found that useful, and I'll see you in the next video.